We're going to be talking about intraday trading futures, specifically the NASDAQ E-mini and a strategy that I've developed. So obviously I need to throw up our risk disclosure. We're not financial advisors or a broker-dealer. None of our officers, employees, representatives. We're not licensed advisors, etc. Obviously, what we do and what we trade, depending on the instrument, involves risk, and you can lose money. So obviously, I'm going to share this with you. My deck is going to be available for download. It's not for redistribution. So please keep it to yourself. If you have a need to reproduce this, then you are obviously obligated to contact us, and there's our contact information. So please keep it here. All right, TheoTrade is a trading education firm. We are based out of Scottsdale, Arizona, and we specialize in the education for options, futures, and stocks. TheoTrade was started by veteran professional traders who are first and foremost very experienced educators. Again, we are not an advisory service or a brokerage firm. We provide the best trading education in the business, hands down. Trading, again, involves risk. It involves real money. And we are here to help you mitigate those risks in the market with classes such as this. The objective with our classes is obviously to teach you something that will last you your entire life. Okay, so today's class agenda, we again have a lot to cover. I plan on doing pretty much an A to Z for the NQ. So we're going to roll through this. We'll get into the basics of the strategy, all the way into the chart, and start talking about levels on the chart, and then we will probably take a break about an hour 10 in, and then we'll resume thereafter. I do have a video that I want to show you guys, so we'll have to get that in there as well. Obviously, you can see we're going to cover pretty much everything. We're going to do a little exercise about reading the tape and kind of do a little scorecard and see how we would have done based on just taking the actual setups that presented themselves. Okay, about me, I have been in the capital markets since the mid-90s, started in the investor relations field, and then moved right into trading stocks, day trading stocks for quite a while. And, with mixed results, I started to trade futures. I did, what everybody does, and I started trading the ES. I found that to be, I just didn't like it, honestly. So I started trading some NQ along with ES, and I just gravitated to the NQ. It's a lot more mechanical in nature. And the way that I kind of landed and really started to focus on the NQ is my very first trade was, basically I kind of dumb luck walked into a winner, and I set out to replicate that trade and fell flat on my face to the point where, I blew up an account, the whole thing. And, thankfully I'm surrounded by wonderful friends and family that helped me and believed in my passion for this game and helped me kind of refund my account. And here I am. So I've developed a strategy for the NQ specifically. It's based purely on price action. That's what we're going to be teaching today. I've had several aha moments throughout this process. I hope to convey some of those to you, and I hope that we have some light bulb moments in here today as a collective group. And obviously, I am here for you guys. I am very active in the Theo chat room, providing trade setups, live trade setups, walking through trades, the practical application of the actual strategy that we're going to go over. So as you guys that are new to Theo come into the chat room, you'll see how I am active and walking through the tape, reading the tape in real time, and allowing you the opportunity to just apply trades to the actual commentary that I am providing. So with futures, and specifically with my stuff, I do kind of bring a lingo with me. So I want to make sure that we go through a little bit of a glossary here this morning That way, and I'm not talking completely over your head. Again, this is going to be for you. This deck is going to be for you to keep. So this page and the next page might be something that you want to actually revisit. Obviously, intraday trading is trading setups during regular trading hours. So the cash session, if you will, which is 9:30 to 4 Eastern time. And, obviously, depending on your time zone, when the market opens and closes. So we like to go home in cash. We're not carrying trades over. We're doing everything that we want to do within the regular trading hours. Price action is simply the analysis of candles on our chart as price develops. The reason that I am so focused on price action as the only indicator for trading is that it is the only thing in this business that is not subjective, right? Technical analysis can lend itself to interpretation. So you might see something I do, or I don't rather, or vice versa, but no one can deny price. Price never lies. You're going to hear me say that quite often. You're going to hear me lean on that, and you're going to see as we start to go through charts that I don't have a lot of indicators other than just pure price. And that's what this strategy is rooted in. Entries are obviously how you get involved. It's executing a trade. A handle is 1 point or 4 ticks. So in other words, from 56 to 57 equals 1 handle. Don't worry if you don't understand what I just said, 56 to 57, you will, I assure you. Spots are levels on our charts that are dedicated for entries. They represent the entire handle. And again, we'll get into what a handle is, what a spot is, etc. I just want you to be aware of what the definition of a spot is. Taking heat, when we talk about taking heat, it means that we're involved in a trade that is going against us. Okay, and we're going to talk through how to get through that, what to look for. And we do that by using these risk markers that are attached to each entry. So these are levels, once we're involved, that we lean against. They don't always get tested, but they are there to provide support for the trade setup that we're in. So if we're long a spot, then we're using the risk marker on the bottom below the spot as support. If we're short on a spot, we're using the marker above the spot as resistance. Risk out, I define risk out by taking a profit on the portion of your position. And it simply means that we can no longer lose money in that setup. We've taken all but a runner all but a runner on the position, and then we're leaving a runner, which is the balance of the trade. And we'll talk about trading size in terms of, trading 2 lots, 3 lots, or even more, and how to split those runners up or leave the runner and manage the runner to make more out of the trade. So the obvious objective is to get risk out of these trades and leave those runners. Once we have risk out, once we have captured a profit on a portion of the position, we put a stop at even on the balance of the trade, and that essentially gives us that risk out situation where we can no longer lose money. So if we get stopped out, we've got net of what we got risk out on, okay? And all of us in this game, and what I try to convey with my methodology, is we are trying to accomplish a daily goal. And you'll see in the room next week as you join us, you'll see a lot of NQ traders in the room saying day done or DD, and that means they've accomplished their goal for the day. And so we have a method to the madness. We'll talk through what a day done is, a trading plan, what might work for you, what's feasible, and what is obviously ridiculous. Because believe me, people have some very lofty goals that are just not feasible, and they need to be grounded in that. WP, you'll see this talked about in the room a lot. This is an abbreviation for the weekly pivot. I do talk in terms of price. I use IMO a lot on the back of my posts, and it simply means that it's in my opinion. Aggressive, short, or long, when I preface a trade setup with the word aggressive, It simply means that we might be at the end of a move. There might be more in it. Price has extended, and therefore the normal setup becomes aggressive. So you don't always have to take those. Sometimes the aggressive short or long is us getting on trend. If a trend is starting to get away from us, but it still has a lot of room left, we might have to step in and take an aggressive trade. You'll hear me say, do not let it go red, right? So, and that is when we're in a position, and this usually coincides with an aggressive setup, whereby the trade might start going our way, but we know that we're kind of chasing it a little, and we want to make sure that this trade's not going to come back on us. So there are, obvious ways that we can put an even stop on the position as it goes our way, or tighten up risk, take pieces off of it to see if it actually does have the momentum to go further in the direction in which we're looking for. FOMO, which is a word that's been, kind of trending lately, and it's fear of missing out, and that is chasing price. So we see a lot of that, people that are shorting lows, people that are buying highs. We simply have to wait for the tape to set up for us. Okay, counter trend means you're going against the trend. Now it's not that you can't do it. You have to understand what you're doing, and you have to understand that this may only owe you a very small pullback or a very small retrace. Okay, and we'll talk about counter trend trades and why you may or may not want to do them. A lot of times we'll miss the trend, and by missing the trend, we may be apprehensive to short a, let's say that the market's trending and there's other things that are leading to it being a quote unquote trend day. So for us to get on trend, sometimes we have to start by counter trend trading to get on trend. When I say take some in the room, if I call out a setup and I say the long setup is X against X, and then that starts to work, I might say, hey, if you're in this, take some. And that just simply means get risk out of that trade. Okay? Inflection points, we're going to be going over these as well. These are weekly pivots, roundies, and 50s. And don't worry about roundies and 50s. I'm going to define those. We're going to spend a decent amount of time on those. A blind buy is stepping in front of a potential trend down. Let's just say it's coming into a spot from above. Price hasn't technically set up, but we know that spots can exhaust, and you step in front of that as a blind buy. Maybe you are keeping track of statistics on spots and how they react to price, and your stat says no matter what, you have to buy that. Blind fade is the same thing, and this is typically around inflection points where we will sell because that is where the market could turn, right? At the end of the day, as you're going to find out, we're able to identify risk no matter what in any trade. When I type in resist, it's just an acronym for resistance, right? So remember, there's a lot of stuff going on throughout the trading day, and I do abbreviate some stuff. So I want to make sure that you guys understand kind of some of the lingo we talk about in the room. And again, for the new folks that are not used to my commentary, these 2 pages might be worth printing out and having them as you join us next week. Okay, so why are we doing this? Why would we trade the NQ on an intraday basis, right? Everyone that has any experience with trading futures might say, man, the NQ is really whippy, or it has a ton of range, or it's super volatile. The main appeal for trading intraday in itself is the ability to generate income during regular trading hours. So again, going home cash, we're not carrying these trades overnight. We're simply entering this market to try to achieve a goal on a daily basis. But the appeal to me, and the reason that I really gravitated to futures, is because it allows us to trade a single instrument to accomplish what we're looking for out of the market versus multiple stocks, multiple industries, seasonality. You're really relying on management teams. and they trade on basically on a 24-hour basis. So you have the ability to get in and out whenever you want to. They provide many trading opportunities throughout the cash session. And we've been seeing, huge volatility and pretty wide ranges as of late. So there's plenty of setups. Again, we're only looking for, a certain amount out of the market. So futures are pretty much, in my opinion, the way to go. But by utilizing price action and our levels, we can identify risk no matter where we are in the market. We can buy highs. We can buy highs because we can identify risk. We can sell lows, but because we can identify risk. That is what gives us an edge. If we cannot do that, then we're just blind trading. So again, fast and volatile, but that is what we thrive on. Okay? It's all about price. So by incorporating spots and risk, we can take advantage of that and get that day done or make our day. So how is the NQ structured? The NQ, again, one handle, that should be a one, one handle or point equals $20 per contract or $5 per tick. So again, let's just use the 56. I don't know why I keep using the 56 spot, but it's okay. So 56 even, 56 quarter, 56 half, 56 3/4, 57, that's the 56 to 57, that's 4 ticks, that's $20 per contract. Gain or loss. Margin requirements, I believe right now are right around 7,700 for full margin. That is on Thinkorswim. A lot of you on Thinkorswim trade on full margin. They do offer an intraday. I would just recommend that you reach out to them and ask them if you qualify. Other firms have intraday margin that can be as low as $500 per contract. Now, I want to talk about that for a second here, and we'll get into that a little more here when we talk about capital and getting started. That is a blessing and a curse, okay? That allows you to trade multiple contracts on a very small account. But think about what I just said. We're talking about a highly leveraged instrument, okay? And just because you have a $5,000 account, they may let you trade 10 contracts. That doesn't mean you should be doing that. That's a good way to completely blow your $5,000 account. Okay, so we'll get into how to manage that and how to use that to your advantage. So getting started, again, you can start with, and a lot of people enter into futures knowing that it is highly leveraged. They've heard all the stories of people making a lot of money, people losing a lot of money, and they start out by, well, I'm going to give it a shot, right? I'm going to throw $10,000 in an account and I'm going to give it a shot, right? And you can do that because with futures, there are no capital requirements other than the firm's requirements that let you get involved. So if it's a full margin, you obviously know how to do the math there. If you have to cover $7,700 per contract, then obviously you want to trade more than one contract. You can do the math on what it's going to require cash in your account to do that. If you're at another firm with that low margin, some of these firms will let you trade with as little as $2,000. Okay. I'm not going to sit here and tell you that you're going to grow $2,000 to $1 million trading the NQ. Right? That's not what this is about. I'm going to tell you that you can grow a small account by abiding by these rules and by having feasible daily goals and then hitting them consistently by using, obviously, our room, our community, all of our other traders in the room with us. We all do this kind of as a cohesive bunch. There's several of us in here. They're all in the chat room right now as well. So, it is very possible to grow a decent little account. Each contract requires that overnight margin. It was 5. I think they raised it to 7 for the volatility. So I encourage you to figure out what a full position is for you. And my recommendation, beginning as a futures trader, is to stick to 2 contracts. As you start to increase size, that is going to be based on your consistency as a trader to put in consistent day dones, if you will, throughout the week. So I'm going to talk through how you go about doing that as we get further into this. And then as you start to show that consistency, I recommend you start trading in thirds. And the reason I would say that is because on our risk out situation, when we are involved in a position or in a trade rather, we have our position, that risk out on trading in thirds, you're taking 2/3. So you're net 8, typically net 8 or net 10 out of the gate before you leave a runner. So then what that does for you from a mental standpoint is it really gives you no emotion tied to that runner whatsoever. And that when you really do not care about the runner, that's when you really start to book sizable handles if you can stay on trend. You obviously want to avoid taking trades home because, I mean, even though they trade overnight, you're going to end up managing it all night, depending on what kind of trader you are. If you do have to take it home, you better make sure you have that money in your account to cover the overnight margin. So if, let's do a hypothetical and let's say that you're upside down in a trade, but the longer time frame chart says you're going to be getting relief at some point, right? And that's the setup, if you will. And you may say, hey, I'm going to hold this overnight. Well, you better have enough money in your account for the margin as well as whatever your drawdown is against that position. Or that you're going to get an email that you'll either get liquidated out of the position and take the loss and then potentially owe the firm even more money. So try to stick to taking setups through the cash session and going home in cash. Again, very volatile, high risk. You need to be comfortable taking losses as you learn. So that's why I recommend starting with enough capital to get through that learning process, right? Don't set yourself up for potential failure with a very small account. And we can talk further about that via email if you guys want to really talk about getting your account set up. So obviously, once you have your account, you need a plan, right? And with any business, and this is a business, you need to have a business plan. So trading futures is no different than opening your retail shop. You need a plan. You need enough money to cover overhead, enough to cover the business that you're in of buying and selling futures. So a solid trading plan is an absolute necessity. So capital, how much capital are you going to dedicate to trading futures? Again, set yourself up for success. Don't have too little capital that you start accumulating some small losses and then all of a sudden they turn out to be 50% of your small account. Okay, that's going to discourage you as a trader. Obviously, you need a feasible daily goal, something that can be contained consistently. I do get some pushback often on what I suggest as a daily goal as being too small. But let me tell you, again, if you're hitting this day in and day out, week in, week out, month in, month out, you will see your account grow and you'll have less stress by trying to attain some big lofty goal. You're setting yourself up for a very tough road to hoe. Risk management, the rules of the strategy are here to obviously ensure capital preservation as you learn. That is that taking those small losses as we go. Okay. I recommend that you have a loss limit for yourself. Some firms actually require you to do a risk assessment loss, whereby if you exceed let's say that your risk assessment is $1,000 for the day, because you know, on paper you're saying, well, hey, if I'm down $1,000, I don't want to keep carving into my account. I just want, someone needs to stop me. And they do it for a reason other than to stop yourself. They are vouching for you by giving you that very small intraday margin, and they are covering their what, right? So that's why they're going to stop you out like that. But let's do that hypothetical here. Let's say that you have a small account with $1,000 loss limit. How many of those days do you have? Okay, so we're going to talk about other situations that may lead you to stop before you even get to that loss limit. For more experienced traders, if you have a loss limit that's too tight. Taking heat on a trade could actually get you stopped out. So we want to make sure that you have that set up correctly, depending on what your goals are. One of the things that you need to learn to recognize is when to stop. We might not have a market that's worthy of trading, and we've seen several of those situations. Okay, we've seen price just get so choppy that it's quote unquote untradeable. And my advice is to step back. This market is open 5 days a week. There'll be another day. If you're having, issues in your personal life, they will absolutely show up in your trading, and you need to obviously recognize when your head's not in it, or knowing when it's just not your day. Taking bad setups, forcing trades, maybe coming into the market with a bias, or maybe you'll set yourself up with, hey, if I lose 3 trades in a row, they could be very small losses, but if they're losses and they're consistent in a row, maybe that's my rule. I'm out. I have several traders that email me that say, if I see 3 losing trades in a row, I'm out. I just won't continue to trade that day. Okay. So trading size, I want to, talk about this again. I recommend trading 2 lots when you're starting. The reason is if you do get into a situation where you might have to take a big stop or a disaster stop, if you will, on a 2 lot, it's going to be a lot less painful than obviously more size. So as you're learning, the reason that I really harp on a 2 lot is that it allows you to get risk out of the trade and leave a runner. If you're trading a single lot, you can't get risk out of a single lot. You're just relegated to scalping the market. There's nothing wrong with that. But it does make you a little more vulnerable to turns in the market versus going with price. Because again, if you take a 1 lot trade and you scalp it and then you enter the next setup, you might be fighting the trend whereby you'd already have a runner on trend. Okay, and we'll go through a few of those examples with some charts here in this presentation. So the volatility in the range in the NQ will provide plenty of opportunities. We've had 200 handle range days. We've had 100 handle range days. We've seen us go through the 100 handle block more than once on any given day. Okay, so if we're only trying to grab a little bit, if we're only trying to grab our quote unquote day done, there's plenty of opportunity to do that. And you can absolutely do that with that size. You can do as much damage or you can make as much as you need on a 2 lot, I assure you. And some of these other traders in here will obviously concur with that. As you get further into this, and I just wanted to mention this, I mean, obviously this is not something you're going to do out of the gate. You got to make sure that this is for you. I definitely recommend that you incorporate or form a general partnership of some kind to take advantage of the tax advantages by running a trading business. Obviously, your accountant, depending on who does your taxes and how you have your taxes set up, can help advise you on setting this up, but it's highly recommended. So getting started, risk management. On any given trade, and once you see the chart, you'll understand this, a typical end trade is based on a 2-to-1 risk reward ratio. Essentially, and what I like to kind of say in the room is that we're risking 4 to make 10. Some folks have a different MO as far as their trading. Some folks are trading scalps on full positions. Regardless of that, the actual setup based on the chart is based on this. We're risking 4 to make 10 or risking 6 to make 10. I have found that to be kind of the sweet spot for risk. And it pretty much is the risk zone around each spot. We can tighten that up as you become more advanced in reading price. You can get entries that are not necessarily on spots and maybe a little closer to markers. But we're not going to get ahead of ourselves at the moment. But once you exceed that 4 to 6 handles, the probability of that setup, I'm not going to say it's out the window, but it lessens. right? You really want to see that reaction from a spot that gets you risk out and breaks that marker to get to the next spot, okay? Hard stops and disaster stops. I do not employ a hard stop methodology at entry. So that is a deal killer for a lot of people when we're talking about when I introduce my methodology to them. They gasp, are you kidding me? No stop? Everyone is taught to use a hard stop as soon as they enter because of the black swans and all of the, the past experiences that they've had. The past experiences that you've had might be because of stops. Stops work. This methodology that I'm going to teach you is based on reading price. Price around markers that have rules, and I'm going to show you when a marker breaks how to take that trade off versus having a hard stop. It's not to say that you're not going to take the same loss, but you want to give yourself an opportunity for this trade to work by allowing price to test a marker. Okay, so I can't really give you a, hey, put a hard stop at 5 handles away from your entry and this should work, right? You get stopped out and then the trade starts to work. This is coming from experience. Believe me, I've done the hard stop thing for the same very reasons. I don't want to enter this market just completely naked with no stop and just let the price run. That's what it takes, honestly. And by using my chart and by watching price related to our levels, you will see how you can actually do this and how actually incorporating hard stops is a detriment to your business. The expanded volatility, however, does give the opportunity for trades to run away. We've been seeing news bombs in the tape that affect the tape. So for this reason, I am recommending using a 15 handle disaster stop on any trade, especially if you're new with me. The reason that I landed on 15 handles is because most of our levels are 10 handles between each other. Right? When we open the chart, you'll see each spot is typically 10 handles between each other, and I'm going to tell you why. That is where typical exhaustion occurs based on my analysis of price action in the NQ. So I don't want you having a 10 handle stop because that's where we could get a reaction if the move is going against you. But however, if it's continuing to slide or continuing to rip to the upside, we want to make sure that we get out of that trade, clear the deck, and then wait for the next setup. It is 15 handles, even on a 2-lot, is absolutely an easy target to make back in this volatility. And I will walk you through that in the room. If you tell me what you're doing in the room, if you're in a trade that's going against you, I'm going to give you potential exits or what I would call escape hatches. It's up to you to take them. Okay? Traders don't like taking losses. But by using this methodology, you're going to be able to take a very small loss versus doing what we're all very guilty of. I'm raising my hand. We all hold bad trades way too long, right? Because we don't want to take that loss. You have to pour out the cup on that. You have to be willing to take a -4 on a full position or a -5. And all this kind of comes into view when you go through the process that I encourage you to go through in terms of homework and showing how when markers do break, price will resolve to that next spot, right? And so if you can avoid taking that excessive heat to find out what's going to happen at the next spot, you want to take that small loss. Risk is a very personal thing. Again, it's commensurate with your account capital. There may be some traders in here that have pretty large accounts and they have the ability to weather some of this heat. There are other traders that simply do not have a tolerance for risk and they actually manage the trade a little too tightly. It all depends on you in terms of what your experience entails and what your actual plan is. If you're scaling into trades into some big position, you can absolutely use my levels. If you're just trading my methodology and my rules, then I want you to stick to the plan. I want you to stay on the reservation. We're not using hard stops. So it's very important that you watch price action around the level that you're leaning on, and that is the marker. So if price is checking into a marker, we want to make sure that we're on our toes and we're watching, but we're not overreacting and getting emotional and counting the loss before it occurs. So price action around the spots and markers are key. We have to let a full 2-minute bar, my strategy is based on 2-minute chart, a full 2-minute bar close when we actually get a test of a marker while we're in a position. What I suggest to you guys is, as you're getting started, if the marker breaks, if you're in a trade and the marker breaks, and I will tell you in the room that your marker is broken and I will say escape hatch is X, then it's up to you to take that. And I have a video of some live trades that I did that I'm going to show you, and thankfully we're able to see in those trades some setups that worked. I believe there's actually a trick trade in there, and then obviously a couple broken markers, and showing you guys how to offer out your position to take that small loss. Again, that's what's going to lead to longevity in this game, is being willing to say, hey, I'm wrong. The chart just told me I'm wrong. I need to get out of this trade and wait for the next setup. So here are spots. They are on our chart as these yellow lines. They're throughout the chart. My strategy is based on the 100 handle block of the NQ. And what I mean by that is the 6,500. So from 6,500 to 6,600, we have spots all the way through, and each risk marker is attached to a spot. So again, we're using spots as entries, and we're leaning on the dashed blue lines as risk markers. When we use spots for entries, let me go back one. When we use a spot for entry, this is how I will say that you're able to identify risk no matter where you are. So again, if you're buying the highs, you can identify risk by the marker below the spot. If you're selling the lows, you can identify risk by the marker above the spot. The marker breaks, potential price is turning the other way against you, and you need to get out of that trade. The reason that spots are entries is, again, they are, in my opinion, levels of exhaustion. And it's based on my analysis of price for the NQ. This thing likes to travel in chunks of 10 handles. So most of my spots are 10 handles from each other. So for that reason, when we see price come into a spot from above, we're simply using that as an entry long against the marker below the spot. So we get long the spot, entire position. We can expect a bounce to the nearest point of resistance, which is the marker above the spot. That is where we take risk out. So quite very simply, every spot has a risk zone established. Every spot represents the entire handle. So each line on the chart is going to be on the even level, but it represents the entire handle. So you might see an entry of 56.5, or you might get an entry of 56.25. There might be setups throughout the day that I would recommend splitting the handle in half. Remember, there are 4 ticks. So a lot of times when I want to try to get a long, you'll see many times in the room, I will bid at the half position on the spot to ensure that I get it. It doesn't always owe us a 56 even, right? So you can't be concerned about a couple ticks. You need to actually get involved, period, right? So in this, for the NQ, a couple handles really isn't anything. But so you certainly shouldn't be worried about a couple ticks. We'll get into more of a visual here in just a second. We like to sell spots when they're tested from below. So as you'll see when we go through this process of reading the tape, that exhaustion occurs into spots from below. So if we're bouncing and we've bounced 10 handles into the spot below, we kind of raise the antenna and say, hey, let's short this because this is where the exhaustion could occur. And a lot of times it does. We'll catch a trade into a spot from below that is a way for us to get short. You know, a lot of times here recently, rather, we've seen the market just dump out and continue to dump out. A lot of these levels have been reactive to the trend and have allowed us to get involved and get on trend. And it's simply by just selling the spot. We have seen exhaustion on both sides. Spots only owe you an entry. They are not levels to lean on. So we don't want to get involved saying, hey, I'm getting long 58 and I'm leaning against 56. That's not a trade setup. We're not leaning against them. You get involved on spots because they have markers attached to them. It's the only way we can identify risk. Otherwise, you're kind of off the reservation and doing something else. We don't lean against spots. They only owe you an entry. So let's back up for 1 second, kind of recap. We're talking about a chart that provides dedicated and fixed entries and fixed risk in trading the NQ. All right, so remember that. That is what is key. This is what we're trading. At the end of the day, it's about price action, right? So this is what we're trading. But as you can see, unless you're really, really versed in price and you understand it, most traders either have trend lines going all over the place, maybe they have Fibonacci retracement levels, maybe they have a daily pivot or any kind of level in here to find a way to get involved. For me, it was important to have that visual to say, hey, this is where I do it. This is where I put the trade on, right? So I would, you know, when I first started trading this, just completely guessing and trying to trade price, this looks like a breakout. So I might buy this only to get smoked on that trade. That would turn into a big loss. And after doing this over and over again, I started to realize something. These things are exhausting and they're bouncing off certain levels. The continuation, this is that exhaustion situation that I'm speaking of, okay? Continuation is not always going to occur. These things turn. Obviously, this looks very trendy, right? So you might want to buy that. That's where it reversed. So this is how spots allow us to get involved. So here's the situation. I'm not going to get too, because I do have a slide dedicated to reading the tape. But as you can see, we're coming into these levels from below. They provide resistance. From below, resistance. And this is actually an inflection point. This is what's called a roundie. And this is where the tape turned. And that's why it's an inflection point. So we have a trade set up dedicated to this, to lean against this, and a bigger picture type of trade that will unfold if this stays above us, if this stays as resistance. As you can see, that was where the tape completely turned. But this was just an exercise to show you this is what we're trading, okay? This is how we're actually able to apply trades to that price action. So we're going to talk about risk markers now because, again, we're doing this with no hard stop, right? So it's very important that you understand what a risk marker is and how to use it. So risk markers are used to identify risk from every entry on a spot. These are the actual levels that provide guidance of the overall direction of the tape. If a marker breaks, we know it's going to the next spot. Okay, they are the only level on the chart that has an actual rule attached to them, right? That rule is to get out of a trade when that marker breaks. Again, they're used for risk around an entry on a spot. We can always identify risk no matter what. And if we're getting long a spot, we're using the marker below the spot for support. If we're getting short, we're using the marker above the spot as resistance. These are not hard stops. They are not entries either. We are simply leaning against them as levels and watching price action based on a 2-minute bar and how it reacts to that level. If that 2-minute bar closes below or above the marker, it is considered broken and it opens the corresponding spot. So we might see a marker, getting into a 56 long, and the marker below the 56 is a 52, and that 2-minute bar closes below the 52, it's broken. All right, it's broken. We know that the next spot below is now open. So I will absolutely chime in the room and say, hey, the marker's broken, the 46 is open. If you're long 56, your escape hatch is 52 or 53. And that is that taking a -3 or a -4, that's the small losses that are going to keep you in this game. Here's a visual on the risk markers. Again, they are on every 2 handle. So every handle ending in a 2 throughout the 100 handle block is considered a risk marker. Not every spot is a 6, right? You see 56, 46, 36, 26, most of them are, but not every one of them is. But every marker to provide continuity for this chart is on the 2, and it's again based on my analysis of price to see where these things fail, where they actually provide support, and then keeping on trend and how it provides support, right? So there are plenty trade setups within this entire price schematic, but this is a visual on how markers are supposed to work for you in your trade. So how do we use a risk marker? As price is coming into a spot from above or below, we might be bidding, which means we have a limit order to buy, or we might be offering, which means we have a limit order to short on the spot, depending on the setup. Once we're involved, we're using price around that risk marker. We often see price completely fail out of spot and get a reaction in the way, in our direction, in our favor, if you will. And when that does not happen, this is when risk markers are super important. So again, they're not entries and they're not hard stops. I do have some folks that will use them as entries. Definitely as you start out, stick to the gold lines on the chart as entries only. So when we're getting involved in a long, let me go back to this real quick. This is for this next explanation. Here's a spot test from above. Here is a marker, right? I mean, we can talk about other spot tests. This is another one right here where you can clearly see that it doesn't break. So if you get long, you're doing so against this area. And then living through this price action might be a little stressful for you, but it's all about where the bar closes. So again, if you had a hard stop, even if you had a hard stop lower than that, you're done before the actual move materializes. And this is not a broken marker, so this would have kept you in the trade or allowed you to go again. So as long as that marker remains good, meaning a bar doesn't close below it, you stay in the trade. Price action may override the decision to hold a trade, meaning if we have other indicators in the market that indicate a trend and we're potentially going against that trend, we may just take the trade off and let price set up a little better. The end of the day, when the marker breaks, you absolutely must deploy an exit strategy, period. I'm going to yell at you in the room if you don't. Do not hold trades, especially when they give you those escape hatches. There's been many, many times, even myself, where I said, no, I'm going to hold it because we're near a low. Let's say my marker broke and that indicates that we're going lower. But price action might be setting up and I might say, you know what, I'm going to hold it. Those trades typically do not turn out well. And we almost always have a reflexive bounce into our marker that allows us to get out of that trade. So here's a visual on how the markers work. And then we'll talk about applying trades. I think I have a chart where the exercise is based on this chart. But it's simply watching markers to identify where price wants to go. So in other words, right here, this is where it found exhaustion, right? The spot, notice the bars here. There's not a bar close above it. So if you were short the 06 against the 12, you would have stayed in this trade. Number one, each bar closes under your entry, but this bar never exceeds or breaks the marker. And this is how we get into trades and stay in them. Here again, from the spot, the O2 holds. When I say that a trade only owes you risk out, it is based on this. So if you were to buy this on a spot test from below, you have risk out of the trade and you avoid sitting through this bar. If you were short up here and you got risk out into this area, you're watching price to capture a bigger move because price never reacts or breaks a marker, hence telling us price wants to go the other way. You're able to stay in the trade as it never threatens your runner. When we get into trades like this, we'll identify levels on the chart for potential exits to really capture a really nice runner. And we've been getting really nice runners lately. But I mean, this is how the two handle works. Look at it. 12, the O2, the 92. Here's where it turns, right? So let's just do the hypothetical and say you're short. I mean, there are several handles within this, and there are ways to start to trail your stop to lock some in, to really capture a big portion of this. We may identify a level on the chart that we will cover into. Let's just say it's the 86. Well, hey, if we're short 26 or 06 rather, and we come into the 86, that's a 20 handle runner, right? So getting back to what we're talking about in terms of getting day done, that's a potential day done in itself. That can be a one and done situation. So that's on the down. Here's the up, right? 72 holds it as support. And I have this all kind of, it's hidden right there, but you can kind of see that each marker now holds, and then that's how we start to get on trend. Here's how we come back down. The 12 holds it in, 92. Here's matching lows and non-broken marker. So, we'll apply trades to this in the exercise that we're going to do. This is a visual as to how markers are supposed to work. So inflection points. Yeah, real quick, those in the room, I really appreciate some of my NQ folks helping out with questions. Well, I'm going to do a big Q&A at the end, so please save them for the end, and we'll definitely get the questions answered. I just have a ton to go through, so I want to make sure we're already 45 or almost an hour in. I want to make sure we get all of this in, okay? So long-term inflection points on the NQ include the weekly pivot. We use the weekly pivot as a bull-bear line, which means simply long above and short below. So it's a level on our chart that carries a lot of weight for us. We formulate it. I give you guys the formula, the formula to manually do this, kind of like the old pit guys would do. And it's by taking the weekly chart and taking the previous week bar for that chart, or for the week, I should say, and adding the high, the low, and the close, and dividing it by 3. That equals your weekly pivot. That formula, the high, low, close divided by 3, is the pivot formula for any time frame. So if you wanted to do a daily pivot, you simply do the same exercise on your daily chart for the daily bar. If you wanted to do a 3-day pivot or a 4-day pivot, any time frame, it's high plus low plus close divided by 3. Weekly pivot is what I focus on. We like to see a test of that as early as possible in the week. We have been lucky. This week we had weekly pivot trading. Pretty much the entire trade Monday was hugging the weekly pivot. And the bar close for the day was well above the weekly pivot. And that put bulls in control of the tape. And what did they do with it? They ran the tape all week. So they really put together a solid week. We'll see where the weekly pivot ends, and we'll do that formula for next week's weekly pivot. We'll do that together. So again, as we're using it as a bull bear, the logic is based on price remaining and maintaining trade above the weekly pivot equals the bulls being in control. Below, the bears are in control. So we can use that level. A lot of times a weekly pivot will land on a marker or a spot. Sometimes it lands in the middle, and then we'll just adjust the trade accordingly. Usually the spot's still going to be the entry. Other inflection points include those roundies and 50s. A roundie is just the big round level. So the 6,800, 6,900, the 7,000, those are really big round levels and what I call roundies. So we're trading the 100 handle block, right? So 6,800 to 6,900 is the 100 handle block. They are split by the 50. So these are inflection points. These are long-term inflection points. We are using them on an intraday basis based on how they actually set up on the daily chart, right? So we can actually use these and watch them in real time go resistance or support and get involved in the trade based on how that daily chart sets up. And it is a way for us to actually capture a really good chunk on the runner. So based on the logic of roundies and 50s, if a roundie is support, right? If we're going to go 6,800 to 6,900, the 6,800 support seeks the 6,850 before the 6,900. So on a daily chart, if we get a bar close above the level, above the 6,800, but below the 6,850, we can expect a test of the 6,850. Again, we watch this on intraday trades for clues. As that previous chart showed, we saw a roundie go resistance on the intraday trade and completely reverse the market. We want to take advantage of that. We can use them as markers. I typically do not use a roundie or a 50 for a long. I'm usually leaning against them or using them as an entry short against a marker that's attached to them. I'm not typically buying them. The daily mid band is also another inflection point. It's based on Bollinger Bands on your daily chart, and that mid band, I believe it's the 20-day simple day or 20-day simple moving average. I believe that's what the Bollinger Bands are set up as, and visually you'll see how price can hold that in, or the 20 can hold price in rather, and then how we actually go and recapture that, and then it turns to support. We can see that on the daily chart. And again, I'll give you guys some visual examples here as well. Yeah, Elizabeth, I'm going to show you guys a video on trading. All right, so here's kind of the weekly pivot in action, if you will. As we come into this was last week's weekly pivot, last week's weekly pivot was 66.38.17. It's not a spot, so we would get short the 36 spot, looking for a failure if the weekly pivot got tested. As you can see by getting involved in the spot, right, if we waited for the 38 here, we didn't get filled. So we were able to capture a nice move from that spot or from that test. Another go at it would have just produced risk out before getting stopped out. Again, here's where we hop over it. We're maintaining price above the weekly pivot. So as price comes into it, we are getting long. We have a marker. We can identify risk in the trade. We're getting long on that weekly pivot to see if bulls can take the tape back over. So this is a little choppy, but there's plenty of opportunity, as you can see, to get long and see if the weekly pivot's going to hold from there. As we lose it, we typically will get a back test of it before heading lower. You can see how price gravitates to it, kind of reverts back to it, tries to get away, keeps getting pulled back. This is price action around an inflection point. This is why they're inflection points. All right? We didn't get too far away from it. They become potential targets for us as well. And so you might see in the room, hey, I'm getting long the 18 against the 12 looking for a weekly pivot test. Right? Something to that effect. Here are the roundies and the 50s. This is the daily chart, and then that is the mid band, the daily mid band, right? So you can see how we get back through it, and then we get that back test of it. But I want you to notice that this is my daily chart, and all I have highlighted here are the roundies, the 50s, the roundies, the 50s. So the 100 handle block split by the 50. Here it is zoomed in. And it's just based on if a 50 is support, we're heading to the roundy above. If a 50 is support, we're heading to the roundy above. If the roundy is resistance, we're heading to the 50 below. These are daily bars. So for those of you that are swing traders, there is a trade setup based on this process. It obviously entails a decent amount of risk on the trade, so you'd want to size yourself accordingly. But these are the big inflection points to glean clues from on your longer time frames. And again, we watch these in real time, cash session, and we take advantage of these moves. Whereby if you're a swing trader, you might be long a low based on a price setup here, and you simply need it to support the trade that you're in. So here's we're going to walk through the long setup. We're going to take a small break, and then I'm going to show you guys a video of trading, and then we're going to come back because I think that will bring a lot into focus for you. I know we're going through a lot. You're going to have this archived. You're going to need to rewatch it. You're going to need to revisit this deck, if you will, this presentation. You'll have this for as long as you need it. And then obviously you're going to come into the room with me next week, and we're going to provide some practical application to all of the above. So it should come all full circle. So we're going to walk through kind of just how the tape sets up and how we would take advantage of buying spots. So as price is coming into the spot from above, we're going to buy this 06, right? So the 06 has a marker attached to it. It's the 02 right here. And then we have that inflection point right here. So I will tell you in the room that this trade actually requires 6 handles of risk because it's around an inflection point. It's all about where the bar closes. Bar closes above the roundy and above your marker. It never threatens to break the marker. Bar closes above the spot. And when you're hearing me say bar close above, bar close below, this chart tends to act like just a big support and resistance table, right? So if we get a bar close above the 06, we can expect a test of the 12. And that action allows us to get risk out of trades and to get what we call a runner working. If the 12 holds, we've identified levels on the chart, we can look for a 33 test. This is how we capture a big chunk of price with that runner, right? So if we got long 06 or 06 half is where we were long, we would offer into this marker because it has potential to be resistance. But as you can see, if we got risk out of the trade and we went even stop, price never comes back to threaten that runner. And we have a target above, which is the 33, and then you have the weekly pivot up here as well. So there's a great setup here, and we actually did this setup in the room to capture this entire move. We watch higher lows around markers to stay in these trades. Whoops. Okay, that was it for that one. Once, I already kind of did this, but our primary objective on any trade that I will give you in this room or anything that I say is getting risk out of the trade. That is our dirty work, right? That's where we make pretty much the bulk of our handles, by getting risk out. It's the hardest part of this, okay? It is the hardest part of trading, is getting risk out. Stepping into a long as it looks like price is just going to come through. Remember, we look for exhaustion into these levels. This trade actually, you actually took over 6 handles of heat before the trade actually started to work. we expect resistance at the marker above the spot. I know I'm repeating myself, but it's worth repeating. This is why we take a portion of the trade off into this area. It's bouncing, it's going our way. We want to book some. We want to take some right there. Okay? We don't want to see it do one of these and just reverse on us. We want to take some. And then we want to go even stop on our entry. We can no longer lose money. Getting risk out. So we've identified, and we're with the volatility within our price schematic here, we're identifying and seeing price gravitate to these levels, which is allowing us to hold on to runners for bigger profits. I'm going to go into this in more detail through later in the presentation, but just work with me here. So these big chunks of price are based on the roundy, the 12, the 33 up here, the 50 up here, and the 62 up here. So we manage our runner based on knowing this, okay? And with this volatility, we're seeing this day in and day out. So, I mean, this is not a cherry-picked chart by any means. I believe this was Thursday. I think this was Thursday. This happens on a daily basis, a regular basis, I should say. You know, obviously we do have days that are a little more truncated range days, but this pretty much happens over and over and over again. So we get that runner out, we pay attention to the 12, and then we know that we have potential to head into this 33. We can trail a runner to lock some in case it backs up on us before actually reaching the goal that we're looking for. If we trail it too tight and we get stopped out, price is still in action with higher lows to go again. Remember, this is where we took risk out into this marker. So if that wasn't resistance, is it now support? That provides another long setup if you took this trade off prematurely. As long as these markers continue to have bar closes above them, you can hold that runner. And then we head up into these inflection points. This is how we get on trend. See how trendy this got? We went from the roundy to the 50. And we've got entry levels all throughout this. Regardless of if you did not have the gumption to buy this setup for whatever reason and you wanted to let it set up further, this is the higher low setup that you would take based on price heading back through these areas. The short setup. Okay, this is what we're talking about, buying and selling spots. So this is where we would take a short on a spot test from below. This is right at the open, by the way. And this is a lot of times we will trade the very first bar at the open, but we're very, very active in the first hour because that is typically when the trend materializes, or that is typically when that first rush of liquidity starts to come into the market. And we want to take advantage of that. So we simply just apply the normal rules of the strategy by selling a spot on a test from below. This is how we're able to capture a big move by holding these runners. So again, our risk is out into this area because it could be support. Right? Just like this marker was support, this could be support. So we want to obviously take some off. And then the marker broke in the same bar and obviously just slid through all these spots. This is an inflection point. So this 66, we might have a target of just the 50. Well, guess what? I mean, that's 16 handles from your entry. You can choose to hold it because we have another inflection point down here being the weekly pivot. But I mean, we're talking about applying trades to these levels to grab what we need out of the market, right? We don't have to hold this. This offers us a nice scalp potential, but it also offers that runner potential. And I really want your mentality to gravitate towards that, because if we're able to get risk out of the trade, right? If we take that scalp type of mentality, we're done. We missed all of this. Where by just taking risk out and going even stop, we got nothing to lose. We can just simply let price develop. And as you'll see, trading the NQ and watching price, all of these levels are in play, right? We start breaking markers, we're heading to the next spot. If markers hold, we're heading back. The 50 is an inflection point, goes resistance, and seeks this weekly pivot area down here. That was our target on this short. Shorting the 66, taking risk out of the trade, and targeting the weekly pivot. The reason we target the weekly pivot is for the simple purpose that it could go support. This is where the bulls could retake the tape. So we can anticipate a test of that and take the trade off into that. Again, that's a solid 20 plus handle move on your runner. Primary objective, getting risk out of trades. I cannot stress this enough, guys. I cannot stress this enough. If you get involved in a trade and you just hold it and you start counting your money, you start figuring out how much you're going to make on this trade, that trade's going to go against you, right? I mean, we can see this, and this looks all really groovy. We're doing the hindsight thing. In real time, when trade goes your way, I'm going to want you to take some, right? Because we can see price reverse back into you, and I don't want a green trade to go red. We can always go again if you get stopped out. Spot tests, again, on a short basis, only owe you risk out. They only owe you a test of the nearest point of support. Just like a long only owes you a test of the nearest point of resistance. Risk markers are where we take risk out of trades and leave runners. I am repeating this over and over again because it gets lost on people in the actual heat of the moment. So once we have risk out, as long as these markers hold price in and never threaten our runner, we can simply stay in the trade. Here's an entry on a spot test from below. You would have taken full heat into this marker. Once you're involved, and I'm going to show you, for those that are asking, I'm going to show you a video here in a second of actual trades. Once you're involved, get risk out. Or I'm sorry, once you're involved on a short, you want to bid for all but a runner into this area, into this marker. This has potential to be support. So shorting the 18, we would take risk out at the 13 or 14 ahead of the 12, excuse me, and go even stop. Here's how we let a runner run based on what we're talking about in terms of watching markers. So we're short 06. We get risk out into the roundy. And then here's where we would apply those longer time frame rules whereby if a roundy goes resistance, we could be heading all the way here to the 50. And again, it's a common occurrence with this expanded volatility that we've been seeing. So if you choose to hold the runner, I mean, obviously that's a big move. You simply choose to hold it to see if this is going to trend. As long as we're not opening spots again or changing direction into or near your runner, just stay in it. This one, we probably would have captured a big chunk out of this and possibly been out of it by then. But this is how runners hold stuff in. This is a broken marker. Notice how markers, they break and resolve to the spot below. This right here is a broken marker that opens this spot, and that could be where you cover ultimately. This trade setup requires a ton of patience. Probably more patience than I have, but I will walk you through this stuff. A lot of people will put trades on up here, leave them on. Again, as long as it's not threatened by price coming back into their area, they can leave it on and see if we can go after an open spot. I believe this spot was actually open earlier as well. All right, so let's do this. Let's take a break. We're an hour 15 in. I'm going to queue up the video.